Welcome to Stock Market Today, your market briefing with actionable insights on stocks, bonds, crypto, and the events moving markets. Let's get into it. Fed policy is driving massive cross-asset volatility right now, and we're breaking down the exact mechanisms connecting Treasury yields, banking sector performance, and cryptocurrency market swings. This isn't theoretical. These connections are playing out in real time with tradable implications. The federal funds rate currently sits between 3.5 and 3.75%. That's your baseline. But the real story is the uncertainty baked into every asset class as Jerome Powell approaches the end of his term on May 15, 2026. Although there have been rumors, no official nomination has been made for the next Fed chair, and the confirmed timeline remains with Powell until his term concludes on May 15, 2026. That leadership transition is injecting volatility everywhere. Inflation data gives us critical context. The Consumer Price Index for January 2026 came in at 2.4% annualized, according to the Bureau of Labor Statistics. That's the lowest reading since May 2025. Retail sales stayed flat during holiday periods, signaling weakening consumer demand. This dovish data set creates tension with the anticipated leadership change ahead. Let's hit Treasury markets first because yields are the foundation for everything else. The 10-year Treasury yield dropped from 4.26% at the end of January to 3.96% as of March 6th. That's a 30 basis point move in roughly 5 weeks. According to advisor perspectives, this decline reflects increased demand for longer-term government bonds amid uncertainty around artificial intelligence impacts on equity markets and rising geopolitical tensions. The yield curve is steepening. Market projections suggest the 2-year to 10-year spread will exceed 100 basis points by year-end. Here's the critical insight. Even with current declines, longer-term yields are projected to drift toward 4.5% by the end of 2026, while shorter-term yields remain relatively stable. That creates a specific trade setup. Fixed income strategists are recommending bond laddering and intermediate duration exposure. The iShares 3 to 7 year Treasury bond ETF, ticker IEI, and short duration alternatives like SGOV are gaining institutional attention. The belly of the curve offers the best risk reward as the Fed navigates this transition period. Now, banking stocks. Regional banks are caught in a sector rotation out of mega-cap technology and into cyclical real economy plays. Energy, utilities, industrials, and financials are absorbing capital flows as investors reposition for changing monetary policy. But regional banks face unique pressures. The SPDR-SP, Regional Banking ETF, ticker KRE, and the Invesco KBW Regional Banking ETF, ticker RIGS, both reflect sector challenges. Regional banks operate on net interest margin models, so they're extremely sensitive to the yield curve shape and Fed policy shifts. A steepening curve theoretically benefits banks by widening the spread between short-term borrowing costs and long-term lending rates. But tighter credit conditions and potential credit stress keep the outlook mixed. Here's the trade angle. Banks could rally if the Fed signals multiple cuts and the curve steepens aggressively. But uncertainty around borrowing costs and loan performance creates uneven risk. Watch credit spreads and loan growth data for early signals of which way this breaks. Cryptocurrency markets show the cleanest pattern tied to Fed announcements. Bitcoin consistently demonstrates a sell-the-news phenomenon around FOMC meetings. Historical data shows Bitcoin typically declines 3 to 7% within 48 hours following Fed statements, according to research from MXC and FIMEX. The January 2026 FOMC meeting provides a perfect example. Bitcoin fell from approximately $90,400 to $83,383. That's a 7.3% decline in the immediate aftermath, despite pre-announcement rallies. This pattern repeated throughout 2025 and into early 2026. For the March 2026 decision, analysts have mapped 3 scenarios with specific probabilities. The dovish hold scenario carries 25% probability. If Powell emphasizes inflation progress and projects multiple rate cuts, Bitcoin could rally 3 to 5% over 24 hours, breaking the typical sell-off pattern. The neutral hold scenario is weighted at 60% probability. This is a wait-and-see approach with no changes to the dot plot. Expect maintained volatility levels across Bitcoin and altcoins as leadership uncertainty persists. The hawkish scenario involves complete removal of rate cut expectations due to tariff pressures or oil price spikes. This triggers an estimated 8 to 12% Bitcoin decline over the following week, with altcoins facing steeper corrections. That 48-hour window after the announcement is critical for crypto traders. The inter-market connections matter for positioning. Lower borrowing costs from potential rate cuts inject liquidity into markets, supporting risk assets including cryptocurrencies while creating pressure on the yield curve. Conversely, a steepening yield curve with low short rates relative to rising long-term yields may shift allocations toward fixed income and away from high volatility assets like crypto. Investment professionals are implementing barbell approaches in fixed income, focusing on the belly of the curve. Sector rotation strategies are moving capital from growth-centric technology into value sectors. Duration management through targeted ETF exposure allows tactical positioning without full portfolio overhauls. Technical timing based on historical Fed announcement patterns gives crypto traders specific entry and exit frameworks. Let's connect the dots across asset classes. Treasury demand increases when equity volatility spikes or geopolitical risks escalate. That drives yields down and supports bond prices. Regional banks benefit from steepening curves but suffer from tight credit conditions and economic uncertainty. Cryptocurrencies react violently to liquidity expectations, with Fed policy as the primary driver of short-term flows. The current environment creates specific opportunities. In fixed income, intermediate duration treasuries offer the best balance between yield and duration risk. The 3 to 7 year segment avoids both short-term reinvestment risk and long-term rate sensitivity. In banking, selective exposure to institutions with strong credit discipline and diversified revenue streams offers participation in any steepening curve rally while limiting downside from credit issues. In crypto, the 48-hour post-FOMC window is tradable. Historical patterns suggest fading pre-announcement rallies, and waiting for the typical sell-off creates better entry points. If the Fed surprises dovish, the 3 to 5% rally scenario offers quick gains, but risk management is essential given the 60% probability of a neutral hold that maintains current volatility. According to Park Avenue Securities' March 2026 market commentary, the combination of declining inflation, stagnant retail sales, and approaching Fed leadership change creates a unique environment where traditional market relationships are being tested. Cross-asset correlations are elevated, meaning moves in one market ripple through others faster and with greater magnitude. Volatility is elevated and will remain so through the leadership transition. The federal funds rate at 3.5 to 3.75% gives the Fed room to cut if economic data weakens further. But speculation around future policy leadership signals potential policy tightening once a new chair takes over. That creates a window where dovish policy could dominate before a hawkish shift later in 2026. Treasury yields at 3.96% on the 10-year offer value compared to equity earnings yields in many sectors. If the 10-year approaches 4.5% by year-end as projected, bond investors locking in intermediate duration exposure now could capture both yield and potential capital appreciation if rates reverse lower in 2027. Regional banks remain a sector to watch rather than aggressively trade. The setup favors patience until credit conditions stabilize and the yield curve steepening becomes more pronounced. Early movers in financials could capture upside, but the risk-reward doesn't justify heavy positioning yet. Bitcoin and crypto require active management around Fed events. The sell-the-news pattern is consistent enough to build strategies around, but always respect the outlier scenarios where dovish surprises break the pattern. Position sizing and stop losses are non-negotiable in this volatility regime. The Federal Reserve's policy decisions create ripple effects that touch every corner of financial markets. Understanding these connections between Treasury yields, banking sector performance, And cryptocurrency volatility gives you the framework to position ahead of moves rather than react after they happen. The March 2026 FOMC decision represents the next major catalyst. Watch the 48-hour window closely. That wraps your market intel. Trade smart out there. For deeper insights and real-time analysis, visit capitalcopilot.io.